the people buying this stuff from them cannot continue buying at this pace. So the game with NVIDIA is trying to figure out what normal looks like, knowing that 3 years from now, normal is not going to be this.
The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. It is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. Any references to performance of securities are thought to be materially accurate and actual performance may differ. As always, please remember investing involves risk and possible loss of principal capital. Please seek advice from a licensed professional.
And we are back with another edition of the Daily Dots. And as you guys will see, apparently today's hat day. We didn't even coordinate that.
Friday, man.
Your hat's a little bit cooler than mine. You've got
time. No one can see it because there it goes. All right.
I flipped the button.
I'm bad.
It's Ghost in the Machine, man. That's not my fault. I'm representing golf. You're representing bookstores.
Yep, that's about right.
Yeah, I'd say that's about. Yeah, that's about right. That's why I wanted to work with you.
It's funny. The bookstore I bought this at. We went and I told my wife, like, this bookstore sucks. Like, I won't find anything there. You guys might. We leave and I have a giant bag with like 4 books in it and she doesn't get anything. That's how smart I am.
Her and Evie are all upset because they've been there for 3 hours. They can't get you to leave.
I even bought a book for Evie that was for me. It's a kid's encyclopedia that basically is like, here's everything we know and everything we don't know about the world. And that don't know part, I was like, that's cool. That's a cool like take on an encyclopedia.
Yeah, anytime you can start, there's like this line in parenting where when you can start doing fun kind of things with your kids that you can also learn something from.
Right.
You know what I mean? That's where it gets that's where it starts getting fun.
Yeah, I turned to a random page and I was like, what? This is amazing. I didn't know this. And I was like, all right, I have to buy this.
I never realized.
So I read like 2 pages to her every night.
The other cool one too is when your kids get to the point where they'll come home and start telling you things that you didn't know.
Yeah, it's already happening.
Yeah. It didn't. Yeah.
There's been a couple of times where she said something and I'm just like, come on. And then I'll look it up and I'm like, oh, man, that's true.
I know. My youngest has caught me a few times where I'm like, that's not the case. And then I pull it up on my phone and I'm like, uh-oh.
Yeah.
Yeah. He's got me a few times. Okay. So flipping over to markets, obviously, I think the thing that we should probably talk about that we didn't talk a lot about this week, I don't think there's a lot to talk about, but that Citrini note that came out. And for those of you that don't know, that's really what put a lot of the waves through the market this week. Personally, I think that it's kind of a shoot the messenger kind of moment where the guy was playing a thought experiment. Have you noticed all the people that are like mad at him?
Oh yeah. There's people even trying to say he was like
manipulating markets and stuff. And you're like, it was a total thought piece experiment. Like,
and the newsletter industry has a bunch of clowns in it, and that dude is not one of them. Like he's
a serious person.
So good.
Yeah, and he's a serious person that's really trying to get at answers and things like that. The other, and this is totally anecdotal, and don't take anything from this, but with our slightly jaundiced, our jaundiced view of markets right now, we've kind of talked about how it's it's not clear, when I see people getting that frustrated about a piece like that and all like the gnashing of teeth this week, and you look around and you're like, you're 2% off the all-time high. That concerns me. Totally anecdotal, but just listening to that, like you're sitting there going, God, this feels like a market that's just going to get drilled in the face for a 10 to 15% header.
Yeah. And at the end of the day, none of us know when it comes to the AI stuff.
No.
And I will say, I saw you had a post that Dimitri responded to, and his response made me think. One of the beauties of AI, and not just in the financial community, but just kind of broader, is it's like the one area where everyone's not sure of themselves and like gloating about it. Almost most of the commentary I see, people will be like, "But none of us know," and it's just nice to see.
Yeah,
like there is some humility here because I think everyone knows they might say something and then a month later be like, "Oh wow,
yeah,
okay, never mind."
Yeah. On the opposite end of that, and it was a good experiment. They were respectful conversations, but on the opposite end of it, boy, there's still a lot of magical thinking in this market. And not saying that I know how it's going to play out. And I was saying that. I was like, look, I'm not saying it's, we were talking about NVIDIA. I got in a bunch of NVIDIA back and forth with people. if you want to be concerned about this market, go listen to the bull thesis on Nvidia. Like, maybe I'm just talking to really neophyte, know nothing investors. Probably.
You get down in the mud pit with the pigs sometimes.
These were all respectful. Like this was, they seemed. No,
I meant intellectual pigs, not like being mean.
But so the one that
it's like Brent, our buddy Brent. The amount of times I saw him just having like a 4-hour back and forth.
He's a glutton for punishment.
13 followers that like lives in his mom's basement. I'm like, what are you doing?
Well, especially I get exhausted for him because it's always the gold bulls that are going after him. And I'm just like, dude. He in his header in his bio, it says if buy gold or
the guy ran a gold hedge fund.
Yeah,
you didn't like.
Well, and like he and I joked around years ago. One of the first times I had him on, as I was like, your biggest problem, Brent, is that gold bulls have not figured out that the ultimate evolution of a gold bull at that time. I feel differently about it now because things have switched a little bit. But at that time, I was like, the greatest evolution of a gold bull is now a dollar bull. And they think that and the reason I was saying that was because one of the things that he and I were talking about, and this is 17, 18, right? So still in the heart of QE and all that kind of stuff. And I was like, and we were talking about how when it really when the printing press starts running out of ink or you start experiencing the inflation and there starts to be restrictions on this, we were saying that at that time, we'd expect to see a flight to gold and the dollar. Right? Because when we can live on fairy tales, when we can just backload printed money into every single hole that's out there, there's not really a need for dollar and gold, right? Dollar and gold are what you need when the music stops.
Yeah.
And anyway, it's just interesting because you're sitting there going, if you would listen to the other 63 minutes of the presentation rather than the 20 seconds where he said something positive about the dollar, you'd hear that the guy believes that gold should be at anyway, it was a funny deal. But reading it did help me because it helps you realize like what you're up against and what the assumptions are. And the basic assumption is, and what I'm able to get is that the vast majority of Nvidia bulls think 65 to 70% margins are because Nvidia is such a good company and it's like a feature of their company. And they're looking at it from a growth perspective. So the approach they're taking, like one guy said to me, he goes, look, what are you talking about, man? If their growth just stays flat. And I'm like, flat from here? And I go, bud.
They're growing at 70%, bro.
Right. And he goes, but he's like saying if they just stop right here and you go, they're not, that's not what people, buddy, like you're not doing the basic math. The people buying this stuff from them cannot continue buying at this pace. So the game with Nvidia is trying to figure out what normal looks like, knowing that 3 years from now, normal is not going to be this.
Or if it is, man, what a world we live in.
It's just not.
Yeah, because Microsoft and Amazon and Google would be junk credit at that point.
Well, and then what would you have? What would you need? Like 30 to 40% of global GDP dedicated to buying processors and GPUs? I mean, like it's just, it's ridiculous. And again, that's not saying get out of NVIDIA, it's going to collapse.
Sky Daddy's not going to build himself, right?
Well, there you go. But you're just like, so your thesis is that the greatest CapEx cycle in history will just get baked into the cake and it's just going to, and he goes, well, no, they're diversifying. They're selling to more people. And I go, more people that don't have those deep of pockets, bud. Like, look, their margins are enabled. If big tech did not have hundreds of billions to throw at this, they would not be selling those GPUs at that price. Full stop. Yeah. The only reason they're able to get that price is because Google and Facebook and all the big tech companies are saying, give us all you got. They will not continue to say, give us all you got. As a matter of fact, Facebook just came out yesterday and doubled down on using more Google chips.
Unless it started to generate insane returns. But man, is that a leap.
Yeah, and here's what it goes back to me. And we talked about this yesterday, but just put a cap on it. It's really hard. Look, I'm not advocating one or the other. To me, it's a no-go. I don't know. It just looks way too complicated, especially with this backdrop. where, I mean, how long would it take you and I to put together a list of 40 names that we felt highly confident would be up? Now, we may not be right, but we sit there and go, we think the chances are way better than not that these names are 3 to 5x higher 3 years from now. Well, I bet you we could put a list together of 40 names that we felt like that probably in an hour. Well, when I'm looking at those kind of opportunity, right? It's not just is Nvidia good or bad, it's the opportunity cost, right? Like what else, what do I have to give up to own it? And I just see so many, you know what I mean? It's just, I just continue to put Nvidia in the too hard pile. The one thing I will say though, is that one thing that was kind of eye-opening to me is that the bullish thesis is counting on dynamics to play out that have never occurred before. And that doesn't mean they can't, but like, to me, investing is, I want the odds on my side.
At the end of the day, I feel like whatever the coolest stock was for the last 5 years is always going to have a bunch of fans that will come up with any reason to say it's going to. Humans are so good at just drawing a straight line on a trend and be like, it's just going to never end. And I think you're just seeing a bunch of that.
Yeah.
And it maybe the extrapolation does work for another couple 3 years, whatever. Like, but
yeah,
when it comes to best places to put your money, extrapolations that get really far away from you aren't usually the best places for it. Because that's not how humanity works.
Do you know that right now that Nvidia is almost worth 10% of the entire equity market?
I mean, it's worth more than the whole stock market of the UK. I mean,
yeah, that's wild. Yeah, and that's why I just say, like, they're like, oh, you're a bear. And I go, I'm not a bearish. I didn't say it's about to collapse. I didn't say short it. I didn't say go against it. I just sat there and went, you know, I'm trying to think of a good analogy. It's like watching guys like hand dig a well because they're dying of thirst. It's like watching guys hand dig a well and like 5 steps to the right, there's a drinking fountain. You know, you're just like, well, no, I didn't say you couldn't get water out of there, but just you just go push that button. You know what I mean? It just seems too hard. Why don't we give a rundown?
Yeah.
How do we look today?
So another down day and another day because of some AI fears, and in part at least. You finished down about 0.5% in the S&P. Let me get my right list going here. The NASDAQ was down 0.3. Small caps were down 1.7, while equal weight was up a little bit. That's pretty wild. And Mag 7 was down 1.5. So awkwardly, Mag 7 and small caps decided to go down together. The dollar was finally down a little bit, down about 1.13, so not a big deal. Oil up 3%, as we talked about, though, a little bit ago. Basically, everyone hedges Fridays for oil because of the Iran risk. If there's a bombing that's small or there's not a bombing, it will go down Monday as everyone takes the hedges off. But gold up 1.6, silver up over 7, platinum up over 6. As far as yields went, biggest story to me again today, 2 and 10, both down 5 basis points. And this is despite a very warm PPI print again. Like, inflation prints, both CPI, PPI, have been warm. And you're in free fall for yields, which is interesting. I think it's a combo of the AI fears but also like the tariffs getting lower, I think allowed the bond market to be like, breathe a little bit of a sigh of relief, which actually to me makes sense. As far as like, vol was up about almost 5%, so not nothing there. You're back above 20 now in vol. Again, probably some weekend hedging though. As far as single names, speaking of Nvidia, was down another 4.
It was down another 4 today.
Yeah, Apple was down 3.
Yeah,
so
Apple deserves it.
Oracle down another 3. EEM was down 0.26, so another day of outperformance there. Yeah, that's all I got. So similar to where we've been. The market can't really break down in a meaningful way. Obviously can't break higher in a meaningful way. You're just kind of trapped in this like close to flat year-to-date range that you're in.
That's why I was saying yesterday that I actually find it encouraging.
Yeah.
I think this market looks more rational and more sober at any time that I've seen it in a really long time.
Earnings are doing great and the market's not. And that's nice to see whenever you're worried about valuations.
Yeah. That's what you want to fix valuations over an extended period of time. And by extended, I mean, usually, 12 to 24 months, a little sideways action to help it absorb it. But I'm even more looking at just the sober responses. Like, look, I don't, just so people understand, I'm not sitting there saying I think that Nvidia should get bushwhacked. I don't. What I'm saying is it's at a really tricky spot.
But is it going to double in the next 2 years?
Yeah,
Probably not.
No. But I think the way the market's dealing with it makes a lot of sense.
It's 2 quarters in a row where they basically had blowout results and the market was like, it says a lot.
Yeah, and that was one of the things I was trying to explain to people, and that's another reason why I think the markets are functioning. The reason they're doing this is the markets are looking out 18 to 24 months, and they're trying to figure out what it looks like then. That's what they should. It's crazy because I've been so, talking about how this market is so whacked out, right? But then I see that and I'm like, this is sobriety. That's what it should be doing, and that's the question, right? Like. That, to me, that should be the thing that the Nvidia debate hangs on is, they're killing it. That's not the question. The question is what do those margins look like 2 years from now? What does the run rate look? Bottom line is we don't know. We know that they're benefiting right now from a CapEx that can't continue.
Yeah.
Right
and
now.
And the first time one hyperscaler kind of bows out of the race will be a big moment.
Yeah. Yeah.
That may be 3 years away or something, but eventually one's going to realize like, oh, we ain't winning. We ain't winning this war and we're spending an insane amount of money. Let's just stop.
Another interesting thing that you said in concert with the PPI comments that you were making and the inflationary comments, I saw another stat today that was pretty interesting. So far this year, the sales of flatbed trucks are going vertical. It's up like 36% year over year.
I do think there's a ton of cyclicality in that because if you go back to COVID, everyone bought one.
I was wondering if it was like a refresh cycle.
And then it went just dead. Because I remember
well, that's what I was thinking. I was like, this is 5 years out. Yep. This would be the perfect time for a refresh cycle, but maybe it's a sign of economic.
Everyone 2 years ago, whatever, was like, no one's buying these trucks. We're in a recession. And it's just like, come on. Yeah. Like everyone bought one in COVID. So of course no one's buying one now. But I will say like there are some freight people saying that the pickup has been pretty substantial of late, and it's not all coming from imports, which, the industrial production manufacturing economy has been in a recession for like 6 years or whatever.
Yeah.
More. It's like, it may be bottoming out.
I mean, you could say 20.
Easily could say that.
Yeah.
So, I mean, the thing is since May of 24, you're down 80,000 manufacturing jobs or something. So like, might it be a dead cat bounce? Maybe. Might it be a tariff-driven renaissance? Maybe. But regardless, having the industrial economy pick up a little bit is good to see. And the global growth, I mean, keeps kind of, a lot of places are having their, different PMIs picking up and stuff so global growth is definitely lifting itself.
Yeah. I mean, well, and you hear that, I mean, we were talking about that out of Latin America. I mean, look, when you've got, how many markets have been flat to negative for the last 15, 17 years? When those markets start breaking out and you start seeing some uptick whenever you see an uptick in asset prices and economic activity in a place that has been on mothballs for that long, you got to pay attention.
Right.
You got to pay attention because
so much of that last year that everyone ignored.
Yeah. And they're certainly starting to wake up to it now.
Yeah.
It does. The one thing that does still blow my mind about the market is how slow this market seems to be reacting to it. And it's understandable. The AI distraction, the big tech, all the different things that we've talked about that have been so sexy for so long. And it is funny. The other thing I see, investors are having a really hard time pivoting. It's been so tech for so long. Yeah. And it's been so tech for so long. Right. It's just, you've got this whole, and we've talked about this a lot, but you've got this whole generation of investors now that think, no, tech stocks are the good ones. And you're like, yeah, in a tech bull market,
Right. It's just been so long that it feels like
Right.
that's the only way it works.
It's the only way it works.
And a lot of people, and myself included, I've read about it, but I wasn't there for like the post.com, just winter that tech went through. So like most people weren't investing back then in 2003 or something. So they don't know, all they've ever known is tech is the only place to go.
I know. My career officially started at, '05, technically. So I was at the tail end of that, but it was literally the inverse. If you wanted to make money back then, it was in commodity producers and banks. Like if you tried to touch tech, people laughed at you.
Right.
It literally was the inverse.
I mean, Apple nearly went out of business at one point.
No, I mean, literally there was a decade where if you said, I think you should buy Microsoft, you'd get laughed out of the room.
Yeah.
And it's just like, people won't accept that. People are like, well, why? That's so stupid. Because it got too expensive.
And then it had to do nothing for a decade.
Yeah. It's like a python swallowing a deer. Don't expect it to go running after that. It's got to take some time to suck that thing through. And, eventually the tough part is asset prices can drift way far away from fundamentals for a very long time, but they will always come back in. Always. And, I think that's big. I think that's what you're starting to see.
Yeah. And in a lot of different areas, I think in the inverse, obviously, where there's a lot of deers and pythons right now when it comes to the flows going back to home countries and things. So,
well, you go look at, I mean, in a perfect example, you don't see it in the big tech that everybody owns, but go look at so many of these darlings, right? The Trade Desk, Shop. I mean, there's so Palantir's down massively. You go look at all these, that to me,
MSTR.
Yeah. That to me is much more emblematic of what happened in 99 and 2000. Big tech, I think, is more like synonymous with the Nifty 50. Right. Great companies that nobody could see in their extrapolations, their dominant run coming to an end, So I feel like sometimes the Meg 7 names get thrown in with the tech bubble, but they're in the same industry, but it's not the same dynamic, because the thing in the tech bubble was more similar to the Nifty 50, which is there is no bad price to buy these. Right.
Right. I think Palantir's Tesla, perfect examples of like, what do you mean what is a multiple?
Yeah.
This thing's awesome. I'm going to buy it.
Yeah. Its revenues are up 30%. Yeah. You're like, buddy.
Because to be fair to a lot of the Mag 7, not all, but the 3 or 4 we talk about often, like through a lot of this run, they weren't that expensive.
No. And trying to think.
Because they kept growing their earnings like there was no tomorrow.
When I think about, I'm thinking about my biggest investment mistakes, and that's a pretty distinguished list.
You've done this for a while. It better be a big list.
It's a book now.
Yeah.
So the hardback copy's coming out pretty soon. Biggest investment risk was not being all over those big tech names way harder early on. I had bubble fears, things like that. But part of it's youth. Yeah. Part of it's inexperience.
Part of it's you came to age and you better buy commodities. Part of
that too.
I've noticed everyone, whatever you come of age in, it just stamps. It puts a brand on you, and it's so hard to get away from it.
It does.
Everyone that if you started working in 87 or 08, the chances of you being a super optimistic bull, they're not very high.
No, I've had to learn, and I mean, I'm naturally one of those people I'm a very optimistic person, but I've always been one of those people looking underneath and people are like, what are you doing? I'm like, there's got to be something in here.
I do that with everything, not just markets.
Yeah, I'm just a skeptic.
Right,
a skeptic.
I'm like, what's wrong with what that person just said, no matter what they say, which doesn't make me that fun to hang out with sometimes. But
the other thing is, I can't just walk past or just run over bullshit. I gotta stop and go, hold on a second.
I know, me too. That's a character flaw. I don't care what anybody says.
It isn't. Long term, it helps. Short term, it can be a real pain. But in our business, you have to. You got to call it where you just hold on a second. That didn't fly, right? And it doesn't always mean that maybe you get a good explanation,
right?
But I did. I had to spend a lot of this last run learning how to not be bearish.
100%, me too.
And
because I came of age in 08. Like,
yeah,
I literally got interested in markets. I didn't know what a stock was because of 08. I was like, wait, what?
yeah.
I got to learn about this. How did no one know that was coming? And so, of course, like there's a big inner bear in there.
Yeah. Yeah. That was why I will never, that was a really weird time. COVID was probably similar. The most I felt similar to that. Remember that January, you and I were working together on a daily basis back then, but even though you hadn't started with us, but remember that January
Don't
leading
tell
up
the Air Force.
Yeah. Remember that January leading up to COVID where you're watching the market go up every day and you're just sitting there going, these people are out of their minds.
Yeah.
They're shutting down the entire manufacturing floor for the entire global economy. And you guys think this is bullish? But I remember the same thing in 08, driving around and like looking out and it's been in movies before, so I'm not trying to steal it.
Yeah.
But I remember having that thought, looking around going, do these people realize what's happening right now?
Like all the for sale signs and homes and stuff. Like,
and everybody's walking around blissfully unaware. And, meanwhile, I'm reading the stuff about the condition the banks were in. That's one of the things that nobody really talks about and remembers. There were really smart, credible people, if you were listening, which I was, that were talking about those issues in 2005.
Yeah.
2004.
Some of the smartest people blew up hedge funds before it blew up because they were too early. Which is
another reason why
it makes me sad.
Yeah,
like the smartest people didn't win.
So people ask me why. That's not like I get asked all the time, but why is it value with a catalyst? Why can't you just buy value? Living through experiences like that told me, right? And here's the weird dynamic too. The deeper the value, ironically, the more careful you have to be. Which is a weird thing. You'd sit there and go, no, because the deeper the value, what I've found out is the more skepticism, right? The cheaper it is, the more skepticism there is that they can pull it off.
Absolutely.
And so usually those are the hardest ones to break out of the mud, even though you're sitting there going, but when they break out of the mud, that's when, they usually rip.
It reminds me of platinum in the last 2 years. I mean, it went sideways for like 20 years. The investment case got really good.
It was coiling.
And then it stayed a really good story for the future for months and months and months and months. And all of a sudden it just did 10 years of price action in 6 months. Like the story didn't get that much better in that 6 months. The market just decided to like, oh, okay.
No, well, I think what happened is people went, oh, we need platinum. You know what I mean? It was like that dumb. And that's what I'm saying is I'm seeing signs of the market because we were operating like that for a really long time. I feel I'm seeing signs that that's getting better, that the market's starting to look out at things. Because remember how frustrated we were? You'd sit there and go, you'd literally be expecting a market response. You wouldn't see it. So then you'd be like, oh, I guess I was wrong. And then 3 weeks later, all of a sudden that price act and you're going, nothing's changed. Well, what changed was literally they couldn't look out a month ahead. And when they used the last widget, they're like, oh, we need some more of these. You know what I mean? Like as sophomoric as that sounds, that's how dumb it was.
Yeah. This reminds me of the poker analogy I always come back to in markets. And that is in markets, you're not just playing the cards, you're playing the other players. And if you don't take that into consideration, it can be brutal. So you can have the best investment case in the world. If other people don't look at it or care about it, it doesn't matter. Yep. At the TG Macro conference, someone told this story about Grant Williams about Tony Deaton. He bought this like salmon fishery in Scandinavia, tiny little company, and he would go back every year. The thing just was sideways. Earnings were great and stuff, but like he'd go back every year, meet with the team, and look at it. Every year, be like, this is a better company than when I bought it. Cool. And then one day, it got like a newspaper article written about it, took off. So like he just sat in it for year after year after year and it did nothing. And then one newspaper article, and everyone's like, oh, this is amazing. I want to buy it. And it's like, boom. You're playing the other players, not just the cards.
Yep.
The business didn't change. Just people decided to buy it.
And we've talked, and I've said this 100 times, but I can't reinforce it enough. When you are looking at markets, you are not seeing real prices. You are seeing interpretations of price. Okay. Just like, I think that if you're going to start investing in earnest and you're going to start operating in these markets on a consistent basis, You have to understand that, right? You cannot look at market prices like they're real. They're not. They're just not. It's an interpretation of a price, or it's an interpretation.
But you can't ignore it either, because
can't ignore it either.
That's where the market clears, and
100%.
You don't get to play your own game.
100%. But just understand that's a market price. Do not sit there and think. Don't invert that with the actual value of the asset.
Right. Platinum wasn't worth $900 2 years ago or whatever.
Right. Gold was not worth $1,800 3 years ago. Right.
The beauty of that is you could have bought it for $900 though.
Yes. Well, this gets into value investing, right? And this gets into why I'm ringing the bell so much on that, because that's the way markets work. We're coming out of the biggest one sector market momentum play ever. You got to know naturally on the other end of that. And this is just understanding the way markets work. When that's working, when that starts to stall and have problems, you know there's going to be a ton of value opportunities out there. Why? Because the way you won over the previous 15 years was not paying attention to valuations. And rightfully so, because we, at least I did, underestimated the profitability and the growth potential of so many of those big companies, right?
Yeah.
So what do you do then? Over a long enough time, you train investors to no longer pay attention to those things. Well, if they're not paying attention to them, then there's going to be a lot of really cheap ones. And that's just, you and I talk about this, but that's one of the things I love about markets, right? They don't miss anything. Eventually they'll come back to it and get it. And and if you get all this over here, wait long enough, you're going to get the exact opposite.
If you really think about it, what being a good investor is being good at arbitraging human nature.
Yeah, that's a good way to put it.
Like, people don't really change. So we run in these cycles of getting too excited and under excited about things. Like, if you just sort of take the opposite wave, so often just that alone, just arbitraging human nature does its thing. We talk about the extrapolation. If you know everyone's going to extrapolate and you don't, you win. Yep.
It's also getting to the point where, I don't know. I don't know when I would say this. Maybe if we went back 7 years ago, I didn't really understand this, but really understanding the concept of somebody saying, what they mean when they say it's too hard. Right? Like, understand. I don't think I really understood that concept until maybe 4 or 5 years ago, where you just go, wait a second. At the end of the day, this is about compounding wealth. Okay. Even if it's not sexy and nobody really likes it, and all that, if I see a really easy way to make 40, 50% over here, that 40 to 50% spends just like any other 40 to 50, right? Yeah. Your money doesn't care what names makes it.
Or how cute it is, or smart it sounds if you tell someone about it, or
this is a money game, man. All it cares about is who makes the most, right? And I don't want to sound like a guy that only cares about money, but investing it's pretty easy scoreboard.
Tell us more, Scrooge McDuck.
Yeah, I would, but I got to go swim in my money bin. I got to perfect my dive into gold coins.
Great show.
It was a really good show. Darkwing Duck was pretty good too.
Oh yeah,
remember Darkwing Duck? Yeah,
I think that came on right around Animaniacs.
That was back in the day when you got home from school and everybody watched the same cartoons.
Yep.
Nobody does that anymore.
No, we all have completely different, terrible algorithm-based YouTube feed or something.
No kidding. Speaking of which, I was ripping my sons, not ripping them, but I was getting after them the other night because they like to watch these YouTube shorts. Have you seen that study that came out recently? And it makes perfect sense about how these short videos are actually making people dumb.
I have no doubt about that.
100%.
And everyone watches. So if you just look at, if you're like at airport, wherever, and you look at someone under the age of say 25 and what they're doing on their phone, it's almost always the YouTube Shorts, or what's the other stupid platform called?
TikTok.
Yeah, that one.
I can't stand them.
I can't either.
I
can't watch it.
No, because I'm like.
Also, make sure you watch our shorts on YouTube.
Yeah, there you go. Well, we actually do our shorts a little bit. We actually do our shorts a little bit different. We actually do our shorts on things that can be talked in totality in very short periods of time, right? So maybe I'm making a justification here. I don't know.
I don't know either, but I can't wrap my head around why they have traction.
Yeah, I just like longer form information. I like more complete. I don't want quick hitters of.
Right. That's why I can't watch CNBC when they have a really smart person on and they talk to him for 3 minutes and they interrupt him 4 times.
Yeah.
Like, I want to know what this person thinks.
Well, you know what it's like?
That's why Real Vision was awesome until they went
Oh,
all in on crypto.
man. God dang it. I hate it when people bring that up because when I first discovered Real Vision for the first time, I was just like, this is heaven.
It was stunning.
It was heaven.
Yeah.
And then, yeah, it's like that party died. Crypto paid better.
There you go.
You got more subs.
Well, I don't know. I would assume they're not doing better anymore, but
Anymore? I don't know. Cause
but maybe that's just my bias because I don't watch it anymore. Who knows? Or all my friends don't, but maybe there's a bajillion crypto people that do. So you may be right.
I don't know.
I'm just having fun staying poor instead.
Yeah, I still mourn I loved what that was.
The early days of the Rinse.
Oh, so good.
Grant Williams with someone one-on-one for 2 hours.
Oh, so good.
Yeah.
And that's those short hitters. I don't get the point. Like, no, I'd rather hear 20 minutes of a 2-hour conversation than listen to shorts.
Seeing Druck take a 3-minute interview just makes me want to pull my hair out.
Oh, yeah.
Or PTJ or something like, man, I really want to know what this person actually thinks.
I'd be like, hey, so we got God on the phone. We're going to give him 90 seconds here. And we'll get back to the stories.
And then we'll interrupt him a few times.
Yeah. And I'm not calling him God. I thought it was a funny joke.
The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. Any references to performance of securities are thought to be materially accurate and actual performance may differ.
What else do we see today? There's so many different things.
Private credit keeps having problems and the banks are starting to have problems because they have some tie-ins and stuff. So like every time someone tells me to buy banks, they go down 10%, like instantly. It just keeps happening.
I'm not anti them. I have just pushed back. I don't understand the narrative behind that. I think it is a really dumb, stupid call. I have, again, looking at this board and you want banks. Okay. I just don't get it. We haven't put a dime toward it. I'm glad we haven't. Much rather own EEM, much rather own metals producer. I feel like this market sometimes is like, hey, who has the worst idea?
Yeah.
And maybe there's some good banks out there. I'm not saying it, but when you look at the issues that you're seeing in private credit, when you look at what's coming down the pipe, and it seems to be starting in private equity.
Yeah, it does.
You don't know what the exposure is. I want nothing. I don't want to be around anything that holds that paper. I don't want to be adjacent across the street from it. I want nowhere near it.
Yeah. Because the biggest, deepest pools of capital on earth are just all in.
Yeah. And listen,
scary.
I would be shocked if you do not hear of substantial banks or substantial financial institutions that as this rolls out, as private equity unravels, you will see names that make an announcement that have their stock drop 20 to 30% overnight.
If they don't get this in Grandma Karen's 401k stat, it's going to be a problem.
You know what? I actually saw something the other day that really encouraged me about that. I think it was Besant. Besant said, we're not going to let private equity load their trash into people's 401ks. And I sat there and I went, thank God somebody at least said it.
I hope they hold to that.
They have to.
Because that industry is begging for that.
They are begging for
it. The cockroaches are starting to pop up more and more.
And look, just to dive back into that, just like a public service announcement. Guys, if you want to know how crooked and how bad these guys are, go back and Google Larry Fink private equity ETF and go look at the timing of that. And then ask yourselves this really important question. Remember, private equity was all accredited investors, right?
Right.
Chase, do you remember any of the heads of the big banks telling you about all the private equity opportunities and everybody needed to be all in around 2011, 2012 when there were incredible private equity opportunities? No. We wanted to democratize private equity about 12 or 13 years later.
Once the problems and the cracks started showing.
Once we needed exit liquidity, right? After you guys have been marking your marks up on this paper for a decade, regardless of the underlying financial progress these companies have made. And now it's time to give mom and pa investor a chance at the trough. These guys are I don't even know how they sleep at night. I remember Larry, do you remember when he announced that about the private equity ETF? I remember looking at him going, Dude, how do you go home and kiss your wife?
And they were doing like road shows globally to try to pitch it too.
And remember, for 15 years, no, this is only for accredited investors. Right? No, it's accredited investors. It's a private man's game. Now all of a sudden we want to open it up to the proletariat. God, those guys are dirtbags. They're just dirtbags. They literally have no conscience. You know, you ask them, how do you sleep at night? And they're like on 150 thread count pillow, baby. You know,
it's going to be interesting to see how it unfolds, because I feel like nothing's ever that simple, but it feels like you put this on regular people's balance sheet, or, you know, the losses that come from it. And I'm sure some of the dominoes that fall because of interlinkages throughout the financial system, liquidity problems, you know, you name it.
And here's the issue. It's
going to be real.
Here's the issue that people need to understand, and why I'm saying that you're going to see finance. And I like, you can hold me account if this doesn't happen. If you were to ask me what I feel the chances are on this, I'd say they're as close to 100 as you can get without being there. But this is why I was saying you will see financial institutions, you will see lending institutions, you will see banks that make an announcement and overnight the price of their stocks drops by 20 or 30%. Why? Because people do not realize how phony so many of these prices are in private equity. And so literally, it's not that something bad happened to the bank. What you're going to find out is that an asset they're showing on their balance sheet just isn't, right? Or a group of assets, or this investment in a fund or something like that. It just isn't. Because when we take that stuff out, we've had it clotured, right? In this small environment, and we've assigned the prices to it, and we have no idea what the public market's willing to pay. Well, I'll tell you what they're willing to pay. They're willing to pay way lower than current marks.
Yeah. And the longer you roll these loans and stuff, because, you know, a rolling loan gathers no loss. So, and there's a lot of that going on. So, you know, if you run on a road to kick the can at some point somehow, like, well, we're going to find out, you know.
Well, and here's how it worked, just so people know. I don't know if we talked about this before, but this is a pretty simple explanation, but this is how it worked. So you got a startup company that needs some money, right? And remember, the equity is so valuable that even though they're pre-revenue, no, we're not going to do an equity financing. We're going to do debt financing. And because these guys have to get this money plugged into these private deals, and they want to show their investors that they have access to these deals, they'd take whatever they were given.
Yeah.
Right? Then the company comes back 2 or 3 years later and says, yeah, we need another round. And the guys that issue them the money go, well, you haven't done anything with that money. We're not giving you another round. And they're like, okay, go mark your marks to zero. And then they come back and go, well, hold on. We'll give you some more money.
Yeah.
And that's literally what's been going on. So companies that are worthless, the investors don't want to realize the loss on their balance sheets, and so they finance them again.
And some of the terms and the covenant light and the lack of backstop and stuff is pretty brutal on some of the late stage loans that have been given out.
Dude, there are going to be there will be 60-minute pieces on this where people go, you gave them that much money with for those terms.
Yep.
Why? I'll tell you why. Because private equity was hot. Because remember the sales line? You haven't heard it in a long time, but remember the sales pitch: equity returns at fixed income vol, right? Equity returns.
And hey, you're getting your 2 and 20, right? That's somebody else's problem.
Yeah, all the sugar, none of the weight gains, right? And people bought it. And what I think that you're going to end up seeing is that you might have had fixed income like vol, but you got equity like losses.
Yeah, you can only launder volatility for so long before it pops up. So
it's the Ouroboros. Speaking of which, there are weird scenarios in which snakes
actually do that.
Will try to eat their own tail. I saw it the other day. Do you know how you stop a snake from eating its own tail?
How?
You put hand sanitizer on its head.
What?
Yeah.
Why does that do it?
I don't know, but these are things that you learn.
On a short, I take it.
No. You know what? I think it was a short. I think it was a short. Dang it. Anyway, so
that's why everybody's getting dumber.
Yeah, me right along with them, I guess, apparently. But no, Yeah, I thought that was interesting. But no, the private equity scenario, there's just no way around it. And not fun but these are things that you should learn. When you hear somebody say something and a lot of times you don't even need to do the work.
Right.
When I hear somebody say equity returns with fixed income vol, you go, nope, sorry, stop right there. That doesn't work. Do you know why it doesn't work? The volatility is why you get the higher returns. That's why you get them.
Yeah, 99 out of 100 free lunches are a lot less free than they appear.
What's that one? Well, I haven't seen that one.
Back in the day, there were arbitrage strategies and stuff.
That's what you mean.
Just printing money.
Yeah. Like Buffett's cigars with 5 puffs.
But they have that limited shelf life. If you look at obviously Renaissance, but the firm that Ed Thorpe ran, I mean, the guy was able to crush the market with super limited risk on basically just arbitraging stuff.
Yeah, and that game has gotten much tougher.
Yeah, now everyone has a supercomputer doing it, so good luck.
You know, it'd be fun. I wonder if you could do it. I wonder if they have enough information. It'd be fun if you could go back and see a simulation of markets like in the 60s, because I think it would be a lot easier.
Oh, it's just, I mean, the hunting grounds, especially for the smart people they could do the math and had a computer to just clean up.
Well, there were so many fewer players. Right. I mean, it was just the opportunity set was so much. Yeah. Oh, good golly.
I mean, you get wide spreads between futures and the index, between the index and the underlying equities
that nobody knew about, that nobody was even paying attention to. There were so many little deals.
If you actually go back to the 87 crash, the underlying index and the futures contract, they had a 15% delta between the two. So Ed Thorpe helped close that.
Arbed the living hell out of it.
So he made the 15 for free basically in a week or two. Now, obviously there's some risk that it just stays messed up, but
or in the early days now, and some of these opportunities still exist. And when you look at the way that leverage instruments like futures and options exist, there will be opportunities like this, but not like it was.
Right.
I mean, and Black-Scholes is a very flawed model too.
But even that cracked the code early on how to do it.
Well, yes. Well, think about the arbitrage opportunities that Black-Scholes opened up.
Exactly.
And then think of how crazy it was prior to that.
And then basically since Black-Scholes, you just had the smart math nerds come up with a little bit smarter way of doing it than Black-Scholes. They clean up. Someone else comes along with a better one that's check this out. They clean up. Kind of how it's gone.
I am blanking out real quick, but who did the Black-Scholes? Who invented the Black-Scholes?
Myron. I can't remember if it was Black or Scholes. It was two professors.
That's right. It was Black and Scholes.
Yeah,
that's right. I was trying to.
So it's funny because talking about Ed Thorpe, he came up with literally the same formula basically as them at almost the same exact time. And each step of the way when he'd come up with something, there was usually someone else coming up with something very similar around the same time. And a lot of this would drop in academic papers and stuff. You go present at a conference, a nerd conference, and be like, check this out. But the smartest people would be like, well, let me take that over here to Mr. Market.
Well, yeah, because you can find those arbitrage opportunities right now, but they have to be anticipatory, right? You're going out on a ledge.
They're riskier, right?
Yeah,
it's not a pure arb.
Yeah, my assessment is that this is an arb. It's not a pure arb. Back then, they were just straight up pure arbs.
Everyone else is dumb to give me this opportunity, so I will take it.
Yeah, because nobody else has a computer.
The early options days, I mean, it was just...
Oh, you could have, if you were playing straight, if you understood what was going on and you were playing, you could have posted 50, 60% gains a year, maybe better.
And there were people that were doing it.
And you could do it consistently.
No matter what the market did.
No matter what.
You're just closing arbs.
Yeah. And the arbs, and the other thing is nobody had a good understanding at how to price options at all. They wanted a static straight line pricing. And you're going, and it was so inefficient. It still is. I mean,
there are still opportunities in options markets.
Yeah. Sure. I mean, we've had some big hits on some of those plays where you're sitting there going, wait a second.
Convexity at times is given away.
Yeah. You're pricing a 40% move on this stock like it's a 6 or 7 standard deviation event. Depending on the news we get in the next 60 days, it's probably going to move 30 or 40%. You can find situations like that, but Like you go back and read through what those guys were doing. I think a lot of the, what was the name of that group of investors? There's a famous name for them. They were like early tech. There was like a group of people that got put together and they focused on this one area. I think it was like back in the 70s. And there's a name for, I'm butch. I'm not giving you any information here.
Are you talking about the Turtles?
The Turtles.
Okay.
That's what I was talking about. Yeah.
Them and like Commodities Corp and some of those guys back then
weren't they playing with option arbitrage?
No, I think that the Turtles were trend following and
that's what it was. That's right.
Mostly.
That's right. Yep. And they crushed.
Right.
Yeah. Who put that together?
Ooh, man, why can't I think of his name?
He was famous in his own right.
There was a couple guys because they ran the ad in the newspaper because they had a bet on are these people born or can you train it into somebody? Like the way they were doing it. Yeah. They had a bet and the one guy's like, oh, I can train people. What's
your thought on that?
Well,
can you train or can you?
The Turtles proves you can.
Yeah.
I think you have to.
I think you have to have a predisposition.
Yeah, exactly. Right. Exactly.
Yeah. Well, and you and I have seen it. Like, and I am not at all holding myself up to be a paragon of the investing world or anything like that. I will say that I think I was born with certain personality traits that lend to this. I think that you are as well. Whether you want to refer to them in this business as talent or something like that, I don't know. But the one thing you do realize, when you spend enough time
not walking away after losing for 7 years is probably the only talent I have. But go on.
Endurance. Yeah. I can take a lot of pain.
Yeah.
Yeah. You want to be a boxer? Yeah. What's your skill? I can take a punch.
You still like this?
Yep. I can take a punch. Iron chin, man. But you just watch other, it's kind of one of those deals. You don't know what it is, but you know what it isn't, and you get around some people and you're like, yeah, you don't have the constitution for this. They just don't.
Well, some people can't put on risk. It just freaks them out. So, but that alone gets rid of a bunch of people.
Yeah. Or there's a lot of people that are really good when it comes to managing their own money. And the minute you put them somebody else, it freezes them. And that's a real thing.
Well, yeah. And it makes sense.
Yeah.
It's a whole different ballgame.
Yeah. I wasn't as handicapped by it as other people were, but I was, and I had to work through that for my first two, especially coming out of 08, 09. I was just terrified to pull the trigger on anything, and I had to, when I was running my own account, it was no problem.
Right. YOLO.
Yeah. But all of a sudden you're managing somebody else's money that they need to be there for another purpose. And it changes the game. That's why I always tell people, I go, look, use paper trading accounts to understand the way markets work. They're not going to teach you anything about investing.
True. Even if it's a little bit of money, I always say put the risk on.
Yeah. And if you want to play a paper account to understand the way things move and learn, like the way the market functions, that's great. But don't think that you're learning how to invest. You're not.
That's like,
you have to have risk on to learn how to invest.
That's like completing some passes on air versus completing some passes with Reggie White in your face. It's just.
That's true.
Not the same.
The Minister of Defense, man.
Yeah. That's what watching I run at the Y and I watch these, coaches that are getting overpaid to teach little kids how to play basketball. And I see this girl just shooting her 500 million threes, with the coach. I'm just like, that's not how these threes are going to look like in the game.
No.
Like, why wouldn't you go running at her, for these, because that's what she's going to see in a game.
Yeah. Well, and she can shoot threes on her own hoop.
Yeah. I don't know. The practice like you play thing, it's the same here. It's if you don't have the risk on, it feels so different. You will absolutely not operate in the same way.
Yeah. And the funny thing is, man, is like I said, it really is a constitution, meaning I have seen people that are much smarter than I am that do incredible research, brilliant minds, where literally I'm looking at them and it's kind of one of those things where you go, I almost feel bad managing money because I feel like my clients might all be better off with them. Then you see them manage risk and you go, oh, they just freeze. It's like a deer in the headlights.
To me, what's liberating about investing is that you can get it right 40% of the time and be amazing at investing.
If you do it right.
It's so liberating. Like you don't have to be that smart at the end of the day. I mean, Druck always talks about this. If you get roughly half of them right, but you manage the risk right, you're fine.
Yeah, which is interesting because he outperformed Buffett and he had a lower win percentage.
Makes perfect sense.
Yeah, they paid like
when you
they
get
weighed.
it right, you get it right.
They paid like they weighed when he went after it.
You can take a lot of paper cuts if your wins are not small.
PTJ was the same way,
right?
Like just hang around, and well, you know what? Spitznagel, that's his whole model, right? I mean,
it's just turning it on its head to get outsized booms here and there, and taking a million paper cuts.
Well, Spitznagel takes it to the nth degree, though. Like that guy, like in my opinion, he is like the paragon of investment patience and not getting, like that dude can sit there and
he basically is the guy putting out the nickels in front of the steamroller. He is the steamroller.
He can generate no returns for 8 years versus a market that's up 300% and not even blink.
And then kind of get it back in a week.
Kind of get it back? Like 2x it in a week. I mean, good God. But here's the thing. He's got a pretty consistent track record. You just never know when it's going to pay.
Right.
Like, that's
a tough business.
Yeah. You could never, for instance, you could never use his stuff to run a retirement portfolio.
And the problem is like the business model is for like pensions and stuff to
offset the risk.
A small sleeve with you. That way, at least that holding goes up when everything goes down. But then, so like CalPERS is famous for pulling their money from the vol guys before a big vol event, because like if you have 10 years where you just wasted money on your vol sleeve, you're like, what are we doing with that? Right. It's just like if you have a budget meeting and you're like, what is this streaming crap? We haven't watched it in 2 years. Get rid of it.
And this is the problem with the people on those investment committees. That's where if you know what you're doing and you're an experienced investor, you go, oh, if you've held it for 10 years, you're damn sure not going to sell it.
And and if everyone in the room is like, we should get rid of that, I feel like someone should be like, we should double it then.
100%.
If you guys all want to get rid of it, we should double our allocation.
100%. Those are the guys that want to sell the VIX at 20 and buy it at 60. And that's another thing. I very rarely see somebody able to make that mental switch, right? That being I don't know what you call that, but it's like something inside of somebody where they just cannot pull the trigger until it's a bad time.
Human nature, honestly.
It is.
We are wired for it.
No, I know.
Absolutely wired to do the worst things at the worst times in markets.
I know.
So until you overcome that, you will not be good at it.
Why do I like golf? It should be like cornhole or like bocce ball or something. Like, no, just because golf is so similar to investing. In golf, there's a well, and they say it in investing too, but golf is a game that's played on a course that's 8 inches between your ears.
Right.
Investing is the same way.
Yeah, I think a lot of sports are the same. Like, if you think of the Bobby Knight School of Basketball, it was risk management. It was all about limiting mistakes.
Yep.
Like, make less mistakes. Forget all the making a hoop or whatever. Like, make less mistakes. Or tennis, so often it's just make less unforced errors than the other guy.
Yep.
That's it. Just don't make as many mistakes and you'll win.
Manage risk.
Yeah. So
don't take big hits.
You could go for that monster forehand down the line, but should you?
Yeah. Yeah. What's the risk reward? Right. What's the cost benefit? Like all that other kind of stuff. What else you got?
And tin cup, you could try to go over the trees or the drink, but should you?
Well, I didn't come all this way to lay up. And that to me is the toughest part, right? Like, because there are those times where it's like, you know what? Now's the time to push chips in the middle of the table.
Yeah, if there's a couple holes left and you're down 4 strokes, you should probably try to hit it over.
Yeah, yeah.
But
press
if it's the first round, maybe not.
No. Yeah, that's funny. I actually have found that I have an easier time making those decisions now in investing than I do golf.
To me, that makes perfect sense.
Yeah, because I do one every single day.
And the stakes are different.
No, what I'm saying, though, is I have an easier time deciding in golf. In investing. I feel much more comfortable making the layup or go for it decision in investing than I do in golf.
Yeah, I think it makes sense.
Yeah. What else you got?
Nothing.
Anything else?
We're pushing an hour.
Well, I know, but it's a Friday show, man. It's the week.
True.
It's the week roundup. And I'm just trying to make sure that we went over everything. It's Citrini, Nvidia. We got to have big tech earnings coming up next week too.
No, we just got through most of them.
Really?
So earnings should be a lot less loud for moving forward. There's still a couple of big names here.
You see Netflix popping 17% today because they didn't get the Warner Brothers deal?
I mean, they were going to pay a lot. So.
Were they?
If Warner Brothers only knew how much they were worth a year ago, maybe they wouldn't have sold. The bidding war was insane for Warner Brothers.
Is it the catalog? What are they buying?
I don't know. I don't know enough about it it's funny. I owned Warner Brothers just because the chart was good. And then it jumped on the first wave of like, oh, they're going to sell it to Paramount or whoever it was. And I was like, okay, cool, I'm out. And then the giant bidding war started. And that was like that lesson of like, hey, just because your thing's getting bought out, maybe don't sell it.
Well, and today I just sat there and laughed when I saw Netflix up 17% because you and I had a conversation a week ago. I don't know if you remember this. We've literally never talked about that company.
And it turns out all they needed was to not overpay for a competitor.
A week ago, you and I were having a Netflix conversation where I looked at you and I go, and I thought you were going to laugh me out of the room. And I go, dude, do you remember this? Yeah. Where I looked at you kind of guilty and I was like, I don't really want to admit this, man, but
I think it's Paramount that's buying it.
Yeah, like, Paramount bought it.
It makes me feel like one of those, like you're in a bidding war and you're like, the juices are flowing and then you win and you're like,
damn it.
Why did I buy that? I feel like Paramount, whenever Netflix was like, yeah, you guys can have it. It just felt like there had to be a little moment where Paramount was like, should we bought that?
Yeah.
Once the like juices stop flowing and it's yours now.
Buyer's remorse.
Yeah, here's the keys. Have fun.
Yeah, I won. Yeah. You're a king of a burned down kingdom, man.
I feel like there's some people at Netflix that had to kind of be like, whew.
Had to be.
Why were we going to pay that?
Yeah.
I don't know. Maybe it's worth it. I don't know, but whatever.
It's hard to imagine how, but I don't know anything
about TV stuff. I got enough.
I don't know how to price content catalogs.
Yeah. I would butcher that real
that's like
good.
Trying to price out IP. Pricing out IP is difficult.
I got a better chance of pricing out like different grades of sushi fish than I do that.
Here you go. I Dream of Sushi. Have you seen that on Netflix? Yeah. So good.
Speaking of Netflix, yeah.
Speaking of which, that is a play. I was talking to my family about this the other day. I'm dying to go to Japan. Same. I've never been to Japan.
We've been flirting with it back and forth, and then I started flirting with a China Hong Kong trip. Like,
we can't keep Jamie out of there. For you guys that don't know, our junior analyst Jamie. What is Jamie? 26 now.
Yeah. And no one asked me the age.
And he's a great worker, but he loves traveling. I can't help myself. I encourage him to do it. I'm just like,
he's a Brit that basically lives in Asia now.
Yeah, and he just loves him some Japan. He went there. He's like,
I've never known anyone to go to Japan and be like, ugh. Like everyone loves it.
Yeah, I mean, other than the fact it's dirty. No.
Yeah.
No, that's what he's like. He's like, man, everything is so clean. Yeah. The other thing that he told me that was surprising is he's like, and everybody says it's expensive. He's like, dude, I was eating like a king on $25-$30 a day.
Thanks to the exchange rate, it is, and it's shockingly cheap.
Yeah,
to the point where like you hear stories of Americans going, they go to the restaurant and order like 5 dishes and eat 10% of each because it can.
Yeah,
because it's that cheap.
I mean, I would eat a lot more than 10%. I'd get at least 50.
And there are people. I may have already actually talked about this in the show. There are people going on ski trips to Japan, and the travel and the ski trip is cheaper than just going to the mountain in like Tahoe or something.
I believe that. Have you seen the lift passes?
Oh,
I'm going skiing this Sunday for the first time since I think it's like 2007.
I'll send flowers to the hospital.
I was going to say I might be in a body cast on Monday, but last time I went up, I think like a lift pass was $80 or $90. I think they're like $253 now.
Yeah, it's bad, and that's like nationally, it's done that. It's Vail's like that. California's like it just went nuts.
Snowflation, man.
I think one company bought a bunch of them and just.
Yeah. There's a big roll up, and I think they bought Crystal. That's the one we're going to too.
There you go.
Used to be private, or used to be just a separate entity, and now it's owned in a roll up.
I lived in California for about a decade, and I remember the pass from the time I moved there until I left went parabolic.
Really,
we were just lucky. Like a military was like they had really good like passes for military, because if not, none of us would have been going.
Yeah, crazy. Anyway, you got nothing else?
Nope.
All right, you guys, we'll have a great weekend. We will see you again on Monday. As always is the case, you want to track us on social media. You can get me at KYR Radio on X and Chase at Pinecone Macro. Get the video feed of the podcast on YouTube. Just search Know Your Risk Podcast. You guys know the drill. Have a wonderful weekend, And we'll see you next week. You're listening to Know Your Risk Podcast. Download and subscribe at knowyourriskpodcast.com.
Investment advice cannot be given without a client service agreement. Zach Abraham is an investment advisor representative of Trek Financial, an SEC registered investment advisor. Bulwark Capital Management is a marketing name only and does not carry a separate registration.